TheoTrade. This is Don Kaufman. It's October 8th, 2018, and you are watching the Theo Night video. Well, there's about 3 minutes left to play in the period. 3 minutes, of course, to the cash close. And ironically, the S&Ps are down about $3.50. Now, if you just this moment tuned into your screen. What I mean by that, I mean like, hey, listen, you didn't watch the market very much today. You're watching this video. You see the S&P's down 350. Figure, I didn't miss much today. You know, markets were massively unchanged. However, did you take a look at the high versus the low on the screen? I mean, people, we're seeing some fairly wild ranges inside of the S&P futures. The cash open today saw us rip. Now, again, this is, and I just want to mark this up on the screen, display the intraday volatility that played out here. That's a 10-point move to the upside, followed by, get this, that traded the 90 marker all the way down to 28.66. A little math over there, you know, what's a 30-point swing amongst friends? Followed by a rip all the way back to the 90 marker. So if you're looking for some intraday volatility in this marketplace, well, that's exactly what you're effectively getting. Intraday movement is phenomenal. And I have to tell you, I'm really surprised and kind of excited to see that kind of trade action with the bond market effectively closed. Again, here in the US, it happens to be Columbus Day. It's a banking holiday, although they do not close the equity markets. They do, in fact, close the bond markets. All right, let's make a couple points in the midst of some of this volatility, and then we're going to look down a few products. Obviously, we'll talk about the Nasdaq here momentarily, but I think at this point in time, it's much more important to step back from the intraday trade. And I'm going to shut down right there for a moment and go to a slide. Now, I want to make something clear. What you happen to be looking at this moment, it's a screenshot. The reason I brought up this screenshot is this is just about 2 hours after the cash open. Now I'm on Pacific time. Market opens here 6:30 a.m. This one's taken, that screenshot's taken at 8:40 a.m. And what kind of struck me about this, I think, is imperative for every investor, every trader, okay, from every walk of life. You better understand what's going on this screen. First and foremost, okay, 2 hours after the cash open, the S&Ps were down 21 points. All right, no biggie. But what really struck me here is the advanced decline line. You have a marketplace that is, it's under a little bit of duress, right? It's under, you know, down by 20 handles. And the S&P 100 advanced decline line is almost a pure 50-50. There was the closing bell. So you have the S&P, again, the S&P 100's a pure 50-50 with financials at that point completely unchanged. So what gives? Why spend even 2 seconds talking about this? Well, you have to recognize, first of all, that one of your largest sectors, the financials, happen to be flat on a trading day with the S&Ps down 20. That's pretty astounding right there. Because, you know, everything I like to talk about, I look at things from like a risk reward standpoint. You know, like what's the upside potential versus, for instance, the downside associated risk. And when you see an advanced decline line, okay, like this, in the S&P 100, with the S&Ps already down 20, all of a sudden it extends out that risk. Like, you know, well, what's the upside? Let's say you can make a buck. What can you lose? Oh, I don't know, like 5. Would you want to be buying something like this? And the answer is not a chance. It did. And by the way, the market, okay, subsequently today, the marketplace rallied. So there was a rally ultimately kind of underway. By the way, it rallied after this screenshot was taken. But I can't stress enough, right, how dangerous of a situation this happens to effectively be. And again, if you're kind of questioning, you know, well, why? Well, what happens if we did see some correlation kind of grip hold, right? And we will see correlation grip hold. What if this XLF started to actually play a role in the selling, and the XLF started to see some sell side activity with the S&Ps already down 21? And then, in effect, what you get, all right, is 90 products okay, on one side of this, the S&Ps, they would easily, on a day like this, okay, be down, what, 80, 90, 100 points if the financials started to play a role in it. And I cannot stress this enough, because all throughout the course of today's trading session, there are odd rotations going on in this marketplace. Now, I'm going to show you that here in just a few moments. But again, the advanced decline line looms really, really large. I mean, lately we've had what? Interest rates has been, the center of discussion, and interest rates are going up. Okay, with interest rates going up, what does it make sense to get involved in? Right? When I say with interest rates going up, and I'm actually going to mark this up on your screen for just a second. Okay, do we get in here? Do we get into this? Do we get into this? What are those three? Okay, what are those three? These are sectors specifically in the S&P, all right, 500. Those are the sectors themselves. Okay, if you take a look, all right over now to the right-hand side of your screen, and can't click, but it's consumer staples. And that's showing right now on the right-hand side of your screen, consumer staples. Oh, yeah, I want to buy me some consumer staples when the interest rates are flying higher. Doesn't seem to make sense, right? Well, let's cruise over to the next sector, the next best sector, utilities. Oh, yeah, it makes sense to buy utilities in a rising rate environment. No, it doesn't. I'm being a little sarcastic on this front. Absolutely not. What's the last sector over here that's up big? Real estate. All right, the buying of REITs in a rising interest rate environment. Again, there's a desperation right now, okay, amongst those that allocate capital. And the desperation is, where are you going to go? Where are you going to hedge? All right, because there's no bonds to reduce risk within. And it's a big, okay, just grapefruit hanging out there. And not a lot of us have a ton of answers on this front. All you can see, though, is like, again, kind of pending risk. Speaking of risk, the next point I want to make on this afternoon's video happens to be volatility is clearly returning to the marketplace. And we're likely to continue to return to the marketplace so long as the Fed is withdrawing from its quantitative easing, as long as the Fed just has this idea of hikes, okay? As long as they're going to keep that rhetoric, the volatility is going to return to the marketplace. And at this point in time, you have to start thinking much more like tactically. And I've mentioned that a lot. And that is, well, what are your tactics? What do you think? You're just going to be able to buy stocks and hope and pray at this point? I hope in the last few days that a few of the Nasdaq stocks may have scared you off, which I'll show here momentarily. But the reason I'm bringing up volatility, to give you the structure, the feel right now of volatility in the marketplace, okay, I'm going to use the volatility futures. Now, this is not necessarily just short-term stuff over here. When I say I want to give you the feel of volatility, okay, I want you to look out 44 days, the volatility futures, 72 days, 100 days. And effectively what we have here is the volatility is the curve is relatively, okay, flat. So you can see with 44 days, it's about what, 1570-ish, and then it just goes up mildly to about 1580, right? And that's 72 days out, and 100 days out, it jumps, again, just mildly to about 1630. So that's what volatility effectively looks like right now. And you're like, oh, okay, so what does that mean? Well, lately, and for the last, year after year after year, like the last, 5-10 years, volatility structure has looked more like this, much more steep, where the baseline over here was, oh, right, these were 1370. These little monkeys jumped out to like, 1450. Then all the way out here, sometimes they'd be all as high as like, 1610. And the structure of volatility. What this means, the change of the volatility and the change of the skew, okay, it kind of means that risk right now is basically the same as risk into the future. So we've hit this patch of complete and utter uncertainty where the marketplace becomes, on a day-to-day basis, more of this like 50-50 volatility kind of candidate. When I say volatility candidate, I mean it's dicey out there on a day-to-day basis. If you don't believe it, look at the S&P futures. They're saying the same thing as the volatility is. What is that? They're saying, I'm dangerous. I can move either direction. Okay. And you better heed the warning of these volatility futures, because when the short duration volatility futures are at or exceeding, okay, if this 44-day volatility future were to exceed the 72-day, you're in store of some really serious movement. Speaking of which, the bottom of the screen over here, take a look at the VVIX. The VVIX, okay, the volatility index, it did actually clear the 110 hurdle today, but came back in. We're still in kind of a precarious place. It just means that traders, well, they're out there, they're offloading risk. Next on the docket, next point I want to make, let's go look at the Nasdaq, because a lot of the sell side activity has occurred in the Nasdaq. And at this point in time, all right, listen, the Nasdaq has had 3 ugly days. Interesting irony with the Nasdaq is in each of these 3 sell-offs that we've seen, again, corresponding in Thursday, Friday, and Monday, the market has finished way, way off the bottom. The dip buyers, okay, are actually being sucked in. They don't even necessarily recognize that yet. If you've been a dip buyer, what? Did you catch the absolute bottom? Or did you buy the dip at the end of the day only to get sucked in deeper in today's trading session? Think about it for a second. The market is kind of what I call like Pavlov's dog. They're ringing the dinner bell. Let's just make sure that you're not the dinner getting served right now, specifically in the Nasdaq. Because another view I want to give you is look at 180 days, just on a 4-hour chart. And the damage that's been done in the Nasdaq, it's negligible. And I just wanted to throw that out to you that, like, come on, there's no damage that's been done. Like, just look where we are currently, right there. So in 3 days, we're basically back to where we were, kind of like mid-July time frame. This is nothing. It's nothing. Again, this is kind of where the entire summer we sat inside of this range. So a little perspective that, again, I know people are looking at this and thinking like, well, Apple could be very appetizing at 223, right? Nah, maybe it was appetizing at 100. Maybe it was appetizing at 150. This sell-off, though, again, it's negligible, and you need to put that into perspective. There is a bit more sell-side activity occurring right now inside of Amazon. Amazon not only lost the 1900 level, but actually traded into the 1850 handle as this day kind of progressed. Again, I do not, and I want to make this clear, I do not look at anything in the Nasdaq right now as being appetizing. I do not look at it as being a buying opportunity. All I see in there, okay, is a whole lot of traders getting baited into more and more risk. And if the chart doesn't do it justice, I don't know necessarily how to convince you, other than the volume is also spiking in there. Last, again, but definitely not least, earnings are coming up. And to be really specific, there's earnings in many of the financials. Now, the financials, they continue on a day-to-day basis to be the object of my affection. And the reason being is the financials, in the midst of any sell-side activity in the last 3 days, okay, they haven't been involved. What we are seeing inside of the financials, though, are fairly expansive ranges. Check this out on an intraday basis. I want to talk about Mr. Toad's wild ride. We traded 28. Moments later, we're trading 28, almost 30. That is a monumental size move. That's the kind of move that you see in almost a full week inside the XLF. This happened in what? 30 minutes. Okay? There is some volatility emerging inside, again, of these financials. And I just can't stress this enough. You're seeing some sell-side activity occur in the Nasdaq. The financials are the linchpin. Right now, the financials, that is what's holding the S&P 500 together. If the financials throw in the proverbial towel, the marketplace, chicken is done. And the irony is the financials, many of them have earnings coming up later this week. We're starting to enter and to embark upon a much more volatile period of time in this marketplace. Look at rallies as opportunities to sell. Looking at sell, okay, when the market sells off, look for the opportunities to start selling some premium. Thanks, everybody, for joining us here at TheoTrade. Have a wonderful evening. Bye-bye.